Hello everyone and welcome back. Well, 2022 has undoubtedly been one of the craziest years that we've ever seen in stock market investment and trading history. We've had ups, downs and all arounds and some pretty wild movements. But ahead of the FOMC meeting on Wednesday, the market is at a key point of resistance, which usually it will be at, either a support or resistance. In 2020 and 2021, it was all about growth and it was all about being in the market. In 2022 so far, it's kind of been cash is king. Let's have a look at the charts and understand these markets better together heading into a big bit of news. See you soon. Well, welcome back everybody to the channel. Of course, we talk about stocks, commodities, and cryptos daily here on the show. If you like any of those markets, please subscribe and of course, smash that like button if you find value in today's video. Let's begin by talking about some data, some macro, and then we'll get into some individual thought processes behind stocks, indices, cryptos, and commodities. Let's talk about fear and greed index. The fear is still high into the FOMC event that's happening on Wednesday. Fear high? Not necessarily a bad thing if you're fearing bullish. Remember, if everyone else is scared, oftentimes that could be the time to jump into markets. Of course, with caution, and we'll talk about those key levels very soon. If we want to think about 2022 so far, what better way than to stack it up against the last 2 decades of trade? Wow, I think that's a very powerful image that we're looking at here. 2022 is a horror year from an investor's standpoint. And we knew it would be a trader's year because it's a midterm election year, always known for volatility, but it's certainly turning out to be one that's for, the ages in terms of about how we remember it. And I'm sure the volatility hasn't stopped yet for this year. So when we're talking about the Federal Reserve and we're talking about big announcements, we also need to understand that it's not necessarily about the balance sheet, which obviously has been rising and at the moment is set to fall, but it's actually the net liquidity injections that the Fed does. So what that means is that when they have net inflows into the market, it makes sense that they effectively are supporting the flow of the market. When that stops being injected, then the market doesn't like it. So obviously it's all about the market generally getting inflows in terms of overall seeing a huge amount of people, being the Fed, injecting cash along with everybody else feeling good at the same time because the Fed's supporting it. Just think of this next time we look at these markets. Another thing that I think is a big stat, and I thought I'd bring it up here, is that generally during bull markets or bear markets, we see different types of things occurring. One of the things with bear markets is usually huge rallies after huge drops. We have had a big rally recently, but a huge one would usually indicate some kind of bear market is upon us. So we'll be watching this for 2022 very closely. Have we had amazing returns in terms of one-day big bull runs on the Nasdaq so far? Stats would say no. And this is synonymous with really bad markets. Basically a market that tanks and then is automatically bought by algorithms and of course retail, trapping them into trades. Remember, that's a huge part of trading, is understanding that the market is trapping retail into doing the wrong thing so they can dump liquidity to us or pick up liquidity for themselves. Remember the Wyckoff's concept of the composite man, that's really what he's talking about there. The market is one nasty creature trying to take advantage of us. So we'll continue to watch that throughout 2022 and of course subscribe so that we can show you when those types of things are occurring. The Fed policy trails inflation by historic margin. It's nothing new to us. We already know the Fed is useless at really looking after the economy here. However, the market coming down does realistically work into their demand scenario. Remember, they're trying to decrease demand to combat inflation to a degree. And that's really all they can do. They can control the demand side. They cannot control the supply side. So by raising rates, they make us feel poorer. Obviously, the asset classes coming down makes us feel poorer. Demand decreases, and that's very important. If we take a look here at front loading of rate hikes, this is what the general surveys expect from the April survey into the March survey. The Fed is expected to raise 0.5 basis points with another 0.5. So 50 basis points, and then do 25 basis point increments for the rest of the year. Now, this is what the market already expects. So what is really important when we're looking at this Federal Reserve thing is not so much about the interest rate hike or any of those things. It's about the statement afterwards. Is this still what the market's going to be expecting after Federal Chair Jerome Powell's speech. Is he going to come out and say, look, we're pretty happy with where we have the market right now. The market's low. We don't want to crash the economy, so maybe we're going to do a little bit less rate hiking. We don't know what he's going to say yet, but these are all scenarios that are on the table. Now, what is this causing? Well, it's causing mass fear in the market. We showed this in our previous video, which basically shows that net retail is bearish right now at an extreme rate that's well over previous rates. 30.5% versus 60%. That's a huge difference in terms of what people expect here. Another thing is, if we think about back in this top of March into April, people were net positive all of a sudden or neutral in the market. Often, this shows us that maybe the market possibly is topping. So these sentiment reports can be used in conjunction with your technical analysis and other things to try to make a better story about what the economy is going to do next. We also know that bear markets tend to be recessionary. Now, this is an important stat. Are we technically in a technical bear market for the Nasdaq? The answer, yes. Are we in a technical recession for the SP 500? The answer is currently no. So we need to be very, very well aware of the S&P 500 and where it is in terms of top to bottom. Right now, it's not close to 20% just yet, but in a few weeks' time, that is possible. And if it occurs, then these are the stats pointing towards recession. Obviously, we start looking and we say, okay, maybe we do need to sell the rips at that point and get out of our position. So it's something that's very important when you're considering whether this is a full bust of the markets. Let's talk about the markets in the last 24 hours of trade. So if we refresh this chart, what you'll notice is that realistically here, we had a mixture of results. Energy clearly was a sector that money was flowing back into, so were some of the big banks. And I would say tech was muted throughout the day. Apple doing okay, a few others going all right for the session. It was all around, pretty much up, down, and all around. However, it did hit a level that we mentioned in the previous video in terms of the Nasdaq and the S&P 500. Specifically, the S&P 500 went straight into a key resistance that we'll be looking at later. So back off the previous day, contrary to what a lot of people believe, there was another bullish rally into a key resistance ahead of the big news. And this is where the markets get critical, and we have to wait to see what the markets want to do after the FOMC statement, not the rate hike, the FOMC statement. That's the important one. Sectors that were doing well, a little bit of risk on here in some sectors like solar, obviously energy, metals coming back a little bit more defensive to do with inflation plays. That was what was rotating throughout the session. In terms of beat and miss data, we are in earnings after all. 75% beats, so starting to lower here a little bit, but still very high. 732 beats versus 244 misses. All in all, so far, the American economy, at least from the company's perspective, seems to be living up to general market expectations. Let's talk about most anticipated earnings releases. If you're not aware, we do have some big earnings releases coming through. Moderna on the open. We've still got Shopify, Block, Etsy, Uber, Twilio, a whole bunch of, like, let's say, hyper stocks coming out this week. So depending on how they go, I think will really probably dictate what goes on with the hyper stocks that are down somewhere upwards of 80% now on markets tops. So you've got to be very, very careful around those, but they're coming in with low expectations. Do they beat those? Let's talk about fear in the market. The best way to talk about fear, look at the VIX, the volatility index here. This is the one. So we've hit 35 quite a few times, and we talked about how this was probably going to be a peak area of fear and that the market would probably buy that zone. That's what they've done so far this year, and they did it again. And of course, the VIX is dropping here a little bit into the FOMC report. I would say the VIX might spike into the Wednesday session a little bit and then possibly drop off afterwards. But would that be a good trade? Probably not. It's more of a guess than anything else. Educated, of course, but still a guess. Let's look at the US 10-year. This is what's at stake. We're at the point of 2018 into 19, and of course that 2013-14 period. US 10-year, an incredibly important rate in this point. Now, if the market believes inflation is still going to be rampant, expect this to go extremely high and for us to move even higher here on the US 10-year, and that will put downward pressure on things like technology, etc., over the longer term, or at least the shorter term. Here are the areas that we need to be watching. So the US 10-year into a resistance, funnily enough, straight ahead of the FOMC report and the Fed's rate hike. PCC, put call ratios, we already know plenty of puts in the market. If you don't believe me, go and have a look at the SPY puts. You'll notice there's tons of puts sitting all over different strikes, 405, 400 on the SPY, so that's 4,000 for anybody else that doesn't realize. 38, 380, 385. These strikes are all very, very hot with the amount of puts. So people are hedging or at least scared into the FOMC report. And, you know, they could be correct, but in general, a lot of people see this as a contrarian indicator. The market has found a lot of sellers recently in the market. Everyone thinks it's doomed, and we can see that in the sentiment report, at least from retail's perspective. Remember, the market has more information than us, so they're able to make better informed decisions after this FOMC statement. Let's take a look at the DXY. Well, here we have a market that seems to be kind of weakening, or at least something's going on ahead of the big report. So what's occurred into this big report? The market's gone rampant. That is, cash is king. Everyone's gone DXY. They've all jumped out of every asset class in the world. You've got bonds getting tanked, money's coming into cash. You've got stock markets getting tanked, money's coming into cash. What if the DXY starts to drop off? Could that mean that money is flowing out of the dollar index into some of those asset classes? I think it's certainly a logical conclusion, and we're at resistance again ahead of the report. Little surprise, we're right around where we were back in 16 and just around the 20 area. So watch the DXY. It's going to be an important indicator for us in the next couple of days. Move over to gold. A lot of people would say, well, Tom, is money going to gold? Well, no, it's not. People think that gold is some form of hedge against uncertainty. That's not necessarily true. It actually doesn't do that well in inflationary times. It does well in stagflation, absolutely, but we're not to be determined whether we're in that kind of market. So gold's back to maybe a point of some support. We haven't really ascertained whether it is, but certainly it's sold off aggressively. And at this point, I think I'd be neutral on gold to maybe even you could consider slightly bullish just because it's at that previous kind of point of issues. But it's like catching a falling knife. You don't really want to do that, yeah? Not at this stage anyway. US oil continues what we believe, which is that it's in decline, basically a series of lower highs at this point. It'll have to convince us by going above 108 to say that we're going long again on US oil. At this point, that hasn't happened, so it's at resistance, if not looking relatively bearish here on the longer time frame charts. Let's now take a look at the markets. So we'll go here with Tesla first. Well, firstly, Elon Musk is done selling. So supposedly all of his Twitter sales have been completed now, and that helps to, of course, get sentiment back into Tesla. It's funny how he keeps dumping Tesla into retail traders though, and it seems like everyone's lapping it back up. So that's why all of this occurred. We already know that, and of course it made sense. Now we're at a point of resistance heading into the Wednesday session. I think for day traders, they're going to be looking at this little level here, and they're going to say, well, look, if we bounce through that and we move and we close above this level on a smaller time frame, could we be rallying into the previous sub? And I think that's a very relevant kind of trade concept. Conversely, bears will be looking to get it back underneath. And I think where the bears really take control of this market is probably something under around that 845. If they get it back underneath there, it's kind of like they've said, you know what, we've had our sleeping kind of ready to reset, and now we're going further short. Expect though that if that occurs, the rest of the market will also be tanking at the same time. There'll be similarities there with everything else. We've spoken about Facebook a few times. The earnings result obviously was maybe a huge trap. It seems to be trying its best to rally at this stage. If the market does go risk on, I would expect maybe Facebook to do okay based on its previous move and maybe the slight positive sentiment from really the Wall Street players starting to get back into this stock. For longer term traders on something like Facebook, you're looking at a breach of this level, and something like this would be a fantastic position in the future to be looking at it. Remember, you've got to think a lot of steps ahead, and right now all we know is that they punished a lot of people for going short here. Heaps of people would have gotten trapped. They've gone and rallied up, and traditionally when they do something like this, there can be some follow through momentum. So keep a look on it, and of course Facebook is suddenly starting to outperform the other FANG stocks. So that is, it's doing better in comparison, and believe me, it hasn't done better for a long time. It's been a long time since Facebook's done better. It's been a horror show, and it is certainly not a stock that everyone likes. There are a lot of stocks setting up. So Regardless, this is just John Deere. I just picked random. You could look at CRM, you could look at any of these things. They are showing signs of being at point critical ahead of the Fed meeting. We've got here, a decent little kind of, could be accumulation or even distribution base, we don't know. And we're looking for traps set around here. Do we get like a breakthrough and then a full rejection, or do we get a breakthrough and a hold? The FOMC statement comes out, the market decides it likes it for whatever reason, and then all of a sudden we start filling gaps on these types of stocks. That's what we're looking for. And of course, I think we'll make a better decision after the FOMC statement comes out. Same thing on the DAX, sitting at a point of kind of previous support, becoming resistance, little number, 14,000, of course, a mass psych level. We've got that downward trend. We'd be looking for that to breach to show us risk is on in the rest of the world trade. And the DAX is certainly a good option for that. IWM is the same. It's coming back up, but it doesn't tell us anything. If you look at this on the perspective of a weekly, every bear in the sun is going to say, that looks absolutely horrible. I don't want to buy it. I don't blame you. In fact, they might say, I want to sell everything here. Again, I wouldn't say you're wrong. It looks pretty bad. I mean, you've got your Wyckoff distribution up here. You've obviously got your ranging market that's had that kind of false little bit of movement. If you got trapped by that, then they've done a good job and they've sold off. So the market looks net negative here on IWM. But I don't see IWM as a great trigger point because it does give you a lot of false signals. I see it more as the health of the US economy as a whole. And right now it says bad, it doesn't look good. And again, only this statement and the market saying, haha, trapped you guys, suckers, and then pushing it back up would prove otherwise. And we haven't seen that yet. So for now, it still seems to be a sell the rip style market. It's the same thing on the Nasdaq, really. It went to a new low earlier on this week. Here are our previous supports. The market went low. People will have shorted this level. I'm sure a few of you do have shorts that you've added at this zone. What do we know based on everything going on right now? We know that everyone in retail seems short. We know there are a lot of puts short as well. And we know that the market is at a critical zone that is a 13.2 level, a previous kind of resistance through the trend lines. And until we really move above something like this 13.6 here, we don't know that the market wants to go long. At this stage, it still looks net negative. But we're starting to see signs that it's going towards a critical level. And I think if it breaches this zone, there's a good chance it will try to come up here. Conversely, if it sells off this zone, especially if we make a new low, what's going to happen after that? Oh, it's going to be brutal. We expect if you go under here again, a pretty large sell-off to occur. Because at that point, remember, selling here is difficult. We're selling through a huge support level. There's going to be a lot of market traps here. But if we say, no, decision's made back underneath, then you're starting to talk about some serious drops that could occur on these markets. So there's a case to be made always for bulls and bears, and you just need to know when your probabilities are highest. It's what we teach in our mentoring, it's what we teach in, obviously, our communities, etc. It's very important that you understand that this is how you need to do things. Here's the S&P, the best indicator that we've got in terms of markets. Where is it? 4,200. Did we mention that in the last video? Absolutely. This level here and this level here are paramount to the fight of the bulls and the bears. We're at resistance ahead of the big day. We're at downward trend line. We're obviously at that point. Are sellers trying to sell it? Of course. Are buyers looking at it? We'll have to find out whether the Wall Street traders want to push it through. But if they push it through, where becomes the next logical conclusion? 4,300. Will there be a sell the rip here? I think almost undoubtedly they'll try to sell here. And then if we breached back up, would that be a bullish sign? I would say yes. If I was feeling bearish on the market, which I don't blame people for feeling, of course, the market does look absolutely horrible on many stats. And after the FOMC statement, we'll probably figure out what Wall Street wants to do. Let it, kind of course, get involved and figure out what that market's doing first. Don't be predictive, try to be reactive to them. And they will then, make a decision. That decision might be to go bearish and push it through. Then at that stage, you start to say, well, wait a second, how much more can this market go down without actually being terrifying? And this is where people, are going to start to freak out. Right around there. If the market does go bearish, remember, if it goes into like a 3,850 or 3,800, we're entering 20% down. Now, we saw a stat before. If we go over 20%, it does tend to mean not only a technical bearish market, but at that point, are we actually entering full-on recession? A lot of people are saying we're already in recession. GDP is down for a quarter, all those types of things. There's a case to be made both ways. And of course, I understand that we could both be correct. I mean, people could say it's a recession. It could even be a recession where the markets go up. Weird things happen, yeah? Weird things happen. So we're at a point of resistance. That's what we know. We absolutely know that ahead of the Fed, and we know that what happens here will probably dictate the next couple of days, if not the next weeks of trade. We have non-farm payrolls coming out on Friday as well. Remember the jobs number. So a breakthrough, 4,300. A breakthrough, 4,300. I think the bulls are back, and we've all been trapped into this bearish sentiment concept. So this is what's at stake. There's a lot here in the markets. I would continue to look at that. Let's refresh here max pain. We'll have a look at where the max pain setting is for this week. If all options were to expire worthless, where would Wall Street make the most amount of money? And that's come down, pointing towards, we'll make that the 6th. Here we go. That's come down to 429. So that means a little bit of extra net puts have been entered into the market over the last 24 hours. That's dropped about $8, I think. So 430, funnily enough, would be the perfect area for them to close this week. We'll see what happens. Don't rely on this as your only trade, but it certainly makes us understand things. Let's move over to crypto. Crypto seems to be in all sorts of pain train. People's interest, new accounts opening, things that we usually like to see with crypto going up are not happening. People are not opening more accounts. People are not excited about crypto. So it looks like we may be in the crypto winter. And if we are, I've said the same thing now, and I'll probably keep saying it. I'm not sure about Bitcoin in the future too much, but what I do know is that if this occurs, that is at around 850 to, it should probably about 900 to 1,000 days into the halving event, if we decline more and form base, I think it could be very interesting for us to check it out. Let's have a look at Bitcoin here over the last 24 hours. Again, the technicals here, not really showing us too much. Some people will say, well, we've hit support. Yeah, we may have. Again, I'll be looking at the Nasdaq to show risk on before I feel good. But if I go into a 2-hour chart, the way I'd be looking at it is this. We've got a bit of a decline. You've obviously got this chance of a double bottom here. Maybe if it breaches through 39, you can take some scalps to the way long. And do remember, the one thing that's looking a bit better about Bitcoin is shorts decreased for the first time. Look at this. The nasty whales ahead of the FOMC have taken some of their shorts off the table. That is, they've stopped shorting Bitcoin and they've gone net long a little bit more than they were. So that's something we'll continue to watch and is worthwhile watching and looking at. If you haven't already, come follow us over at FX Evolution on Twitter. We always appreciate you guys. Thank you so much for getting us over 5,000 recently. We are posting more there every day. And if we think about the news ahead, obviously we've seen some central banks, such as my one here in Australia, raise rates already, 0.25, so 25 basis points. We scroll on down and we know FOMC statement. There it is. We've got that FOMC statement. It's 2 p.m. We've got the federal funds rate, 2 p.m. But this is the one we want. The press conference, 2:30. What crazy things will Jerome Powell say? I don't know. None of us do. But depending on how the market likes to react to him, we'll find out, hopefully, in the next 24 hours, what this market wants to do, whether it wants to go long or it's actually going to cook itself and go all the way back down. And we need to start thinking about, some diabolical consequences, or at least those next big supports. Thanks so much for watching. If you have enjoyed today's video, please subscribe, smash that like button. We'll see you in the next one. Bye for now.